So this is the US money, which is the liquidity, M2 money that is going to come. And if you see, there are four ways it comes. So first, look at the US government spending. So government spend a lot of money and get pump a lot of money in the market. And when government spending increases, so this year there were like $2 trillion deficit budget. Okay, so this is in spite of, so they spent more than what they are actually collecting in taxes, and they are spending more. And how they are getting this government spending, that is by taking a debt. Okay, and this debt, what was $22 trillion just 3 years ago, is now reached out to $35 trillion. Okay, today, and it's going up, it keeps climbing up. Now this way, when US takes a lot of debt using treasury bonds, notes, or bills, then the money gets more pumped into the market, and then everything gets balloon, right? Now, these two things which are inevitable, they are anyways, they are not going to stop on US government spending, neither they're going to stop on the debts. So these two will continue to happen irrespective of who becomes, the president. But then there are two other levers which government uses, the US government uses to induce liquidity in the market, right? Lot of money in the market. So one is this debt yields, and then this interest rate. So let's look at these two things, because these are the levels and these are changeable. And the government is now telling that they will reduce the interest rate and pump more money in the market. And the debt yields is market driven. Though they try to control it, it is still in the market driven. Now the debt yields have been rising last year, and then since last 1 year the yields are constant. Now I think it is around 5% debt yield, and then the US interest rate is around 5.5% right now. So this is the thing, and it has not been changed since the last 1 year now, since last June. So these are the sources. Now let's look at the other side of the coin, which is where this money actually goes. So the money actually goes in three places, which is, one is the money market, where we call it a short-term money, which goes like in treasury bills, which are typically less than 1 year, and then promissory notes, call money in, and short-term interbank lending, those kind of stuff. And then the big money also goes to capital markets, which is long-term, your stock market, mutual funds, derivatives, bonds, debentures, is all things long-term stuff which comes in the capital markets. And then the real estate. Now you have to understand that if one of the items, let's say stock market, the money which was going to stock market suddenly stops there because of sudden crash, then what happens? The bonds gets benefited. If the bonds money is not going in the bonds, then the stock markets get benefited because it is the same money. This the pumping, the money that is coming here has to go somewhere the other place. So if both this fiat money crashes, then it goes to the real estate, right? So that is how the economics always play. This is a evergreen economics cycle. Okay, now which things goes here, right? Now apart from this, there are commodities like, it can go to gold and other stuff like that, right? So these are the things, right? Now let's look at these two things, which is the debt and the yield interest, because these are the two important things, and we see what is the impact, whether this will go up, go down, and then based on that we will predict whether the US liquidity will increase or not. If it is if this is increasing, if there is more money pumping here, then we know that the stock market will go up and the bonds will go up and these things will go up. So look at these two important things, right? Which the government market is all looking at it. The government officials, Fed officials, and the entire marketing looking at these two levels, because this is what is going to decide whether things will go up or down, right, in the market, whether it is stock market, real estate, and even in India. So if interest rates goes down, then that will create a lot of money in the market, boosting the economy, and then a lot of money in the flow of money in the market via the global markets to the Indian market, and obviously the hyperinflation that is going to happen in all the asset prices, commodities, and that is obviously going to reflect in the real estate and the stock market, and it goes down. This we have seen it from 2020 onwards, that this is what is the case, due to a lot of money coming in the market, not via interest rate but via other dollar printing machine and the debt. right, that they have taken. Now what they are predicting is that now if the market, if the interest rate goes down, then the same thing will happen via interest rate this time, and not via debt, right? So then the other level which people are talking about is that the debt yields. If the US 10-year bond, 20-year bond, 3-year bond, 2-year bond, debt yields actually go down, then if that goes down, then it is easy for the US government to actually renew their bonds at a cheaper rate. And if they ask Fed to actually buy those bonds, then it will be easy for Fed to buy because they did at a lesser interest rate. And that will so the benefit of that is that it will be lower burden on the US government, because US government is actually has to pay the interest for those debt, right? So right now if they are paying at around 5% or 6%, then they will, if the interest, if this yields goes down to 3% again, uh, then they have to pay lesser interest on that. Currently they are paying $1 trillion per year just on this interest. So this burden, if it reduces, it will ease up a lot of things, because there's a lot of money that is government is leaking via this. And if that stops, then if this gets reduced, then more money gets into the market. And obviously the bondholders will be happy, because all these bondholders who bought the US debt at a lower yield, they are not able to sell, because the mark to market, there is a losses, because the yields in the market has gone up, and their yields for the bonds which they are possessing, their yields are lower. So if they feel that if the yields go down, then even their the value of their prices, their yields will also come to the market level, then they will be able to exit the market or whatever. So what can happen, and what I'm predicting is that if the yields goes down, it's going to create a havoc in the market, because if the yields goes down and come at par to what the people have purchased, then what will happen is they will start dumping the US Treasury bonds. And I think China might be waiting just for that. India government also might be waiting for just that, because China has $700 billion of bonds and dollars that they are in the in their foreign exchange reserve. India also has 200 to 50 plus treasury bonds and dollars. So if they have whatever treasury bonds they have, even Japan has, maybe Japan is also waiting for this, that if the yields comes down, then I will go and dump it, and then crash this entire treasury market. So if that happens, then there will be a crash. Then it is when the gold rises actually goes, and the real estate prices will go up. But when it comes to stock market and the dollar, that is what the collapse will happen. And that is when US will be unable to take more debt, and then it will be forced to buy bonds in the open market. Then the Fed will be forced, and Fed cannot buy more bonds, because there is a level to what they can do. And then the US will announce a new currency. So this is my speculation, guys, that this is the trigger of the bubble. Now you ask, when the bubble will happen, whether it will happen, and what is the trigger for that. This is the trigger, US Treasury bonds. If that dumping happens, and that will happen when the US debt yields goes down. So you can't say that the interest rates will go down and yields will remain as is. This is not a possible scenario, and the market is not telling you that, because if the interest rate goes down, then the debt yields also has to go down. And mind you that the interest rates are controlled by Fed, but Fed doesn't control this debt yield. They may try to control, but the market, these are market driven. If there are no buyers, then you can't say that I am going to pay you lesser yields and still take my bonds. It's not possible. So that is why I say that this is the story which no one is telling you, and this is the one which is the oxygen mask of this US economy. You don't care about the inflation number, you don't care about this unemployment, how much they are spending and all those things, because the key thing is, if the lifeline is not controlled by the US, because their debt yield is what is their ability to take more debt. And if the debt stops, then everything stops in the US. So the ability to take debt is based on what yields they are promising, because that is market driven. And if the yields go down, then then countries will exit, and it will create a crash. And if the yields go up, that is another problem, because then the hyperinflation will be there, even with or without this interest rates going down. So watch out for this. People are showing you this in the market, interest rates, they are showing you inflation number, they are showing you unemployment number. That's all bogus. Those are all not the most important numbers. The most important numbers to look at is debt yield. So if you look at the current yields, they have started climbing up. If the yield dumping happens, still the asset prices will rise and gold will rise. That is why I say that gold and real estate is a sweet spot, and stock market and dollar is not. Because in one scenario, the stock market can collapse, and but not in the other scenario, right? So that is why I'm telling that, stay away from the stock market, bet down the real estate and gold, because this is where it is going to be a safe haven in both the cases. And then obviously if the interest rate goes down,